All right, welcome back everybody. Today we're going to be talking about chapter 8, which covers perfect competition. So perfect competition is just one of several market structures that we can study in microeconomics. So a market structure is just a specific type of market that showcases certain features. Now, when we look at different market structures, this is going to allow us to better understand how firms make decisions about how much to produce and what price they're going to charge for their product. First off, we're going to start out by talking about what perfect competition is. Then we're going to see how firms make decisions under perfect competition. And lastly, we're going to talk about entry and exit in the long run. And all this means is whether a firm is going to choose to join an industry, stay in an industry, or leave that industry in the long run. So we begin our discussion of all these different market structures with perfect competition because a perfectly competitive market exhibits a lot of desirable traits. Perfect competition is also relatively easy to study compared to other market structures. So just as we've done before in this class, we want to start with a really simple model, and then later on we can add more and more detail to build out a more thorough analysis. Any perfectly competitive market is going to exhibit all 5 of these traits. First, the market is going to have many buyers and many sellers, and each seller or each firm is going to be relatively small. Now, we also need each firm to be selling an identical product. What this means is that if you go to the market to buy this good, let's say we're talking about oranges, every orange that is being sold, doesn't matter which firm is producing it, an orange is an orange, right? So we have many firms that are all selling an identical product. Fourth, we need these firms to be price takers. And our 3 previous conditions sort of set us up for this 4th one. So what we mean when we say that a firm is a price taker is we mean that this firm doesn't have any power or control over the price at which it sells its product. So with many buyers and sellers and a bunch of small firms that are all selling the exact same good, businesses can't just sell their product for whatever price they want to. Instead, they're going to have to accept the price that is taken in the market. Lastly, these firms need to be able to freely enter and exit the market. All this means is that if a new business wanted to join this industry, they could do that freely and cheaply without a whole lot of regulations blocking them from doing that. Okay, so to illustrate why we need all these characteristics for perfect competition, let's talk about an example of a market that does not satisfy these conditions, and then talk about an example of a market that does. So our example of a market that doesn't satisfy these conditions could be the market for the iPhone. We only have one company or one firm that sells the iPhone, and that is Apple. With just one firm selling this iPhone, it's a pretty big company, right? Apple's a pretty big business. The other thing about the iPhone is that it's a unique product, right? You can only buy it from Apple, you can't get it anywhere else. So these other firms are not able to enter this market for the iPhone. Because Apple has patents or trademarks on the iPhone hardware and software, no other firm can easily enter the market and start producing and selling its own iPhones. Because the Apple is the only business that sells the iPhone, and they know that consumers, if they want it, are going to have to buy it from them, Apple is not a price taker. Apple has full control over the price of the iPhone. So when we're talking about the market for the iPhone, it is definitely not a perfectly competitive market. All right, so to look at an example of a perfectly competitive market, let's consider the market for oranges. So in our market for oranges, we can have many buyers and many sellers, as our sellers are just any farm or orchard that is growing and selling oranges. Each firm in this market is going to be relatively small, and they're not going to have a whole lot of control over the price of oranges. Each firm is selling an identical product. An orange is an orange, so as a consumer, you're indifferent between buying an orange from one farmer versus buying an orange from another farmer. This is the characteristic that disables these firms from controlling the price. Orange producers are going to have to be price takers. If they want to produce and sell oranges, they're going to have to accept the prevailing price for oranges in the market. The reason for this is because if I'm selling oranges and I decide to try and raise the price of my oranges compared to the price that all of my competitors are charging, nobody's going to want to buy my oranges, right? Because all oranges are identical consumers are just going to buy the one that is the cheapest. So what's going to happen in this market is that all orange producers are going to kind of agree on the price of oranges, and they're all going to sell their product at that price. Lastly, there's no sort of barriers or restrictions that are stopping people from growing their own oranges and selling them in the market, right? So we have free entry and exit in this market for oranges. So the reason we want all of these traits to be shown in a perfectly competitive market, and the reason why we like perfect competition, is because perfect competition creates a kind of level playing field for our market. All right, now we want to talk about the decisions that a firm is making about production under perfect competition. So remember that profit is just revenue minus cost. So the firm wants to produce the level of output that is going to maximize its profits. How does a business figure out which level of output is actually going to maximize its profit? This is kind of a tricky question for a business to answer because it doesn't know how much profit it's earned until it has actually produced and sold all of its goods. So if you think about it this way, if you were running a lemonade stand, in order to start your day running the lemonade stand, you'd have to incur some costs, right? Before you open up shop for the day, you're going to have to buy your lemons, your sugar, your paper cups, get your water and your ice, and then you're going to sit out there all day. You're going to sell your lemonade. As you go throughout the day selling lemonade, you're earning some revenue. For each cup of lemonade that you sell, whatever price the customer pays you, you collect as revenue. So you won't know how much profit you've made until the end of the day, after you've already spent all your money on costs and you've collected all of your revenue. So it's very difficult for a business to be looking at the start of the day and say, how much output should I produce in order to maximize my profit? So we need to approach this question from a different angle. So because a firm doesn't know how much profit it's earned until its production is already said and done, instead we have to use marginal analysis. So in order to conduct this kind of marginal analysis, we want to find out how much revenue is associated with each additional unit of output that is produced and sold, and how much additional cost is associated with each additional unit that's produced and sold. So we're going to do this with marginal revenue and marginal cost. So marginal revenue is the additional revenue earned from selling one additional unit of output. We calculate this by finding the total change in revenue for the change in output. Marginal cost we're already familiar with. This is the additional cost that's incurred as we sell one additional unit of output. So marginal cost, MC, is my change in total cost divided by my change in output, or Q. Now, using these terms for marginal revenue and marginal cost, we can also calculate something called marginal profit. And marginal profit is going to be the change in profit that is associated with producing and selling one additional unit of output. So my change in profit can be measured as my marginal revenue minus my marginal cost. Now we need this marginal analysis in order to figure out how a firm maximizes its profit, because it allows us to assess the problem before the end of the day. It allows me to wake up in the morning before I open my lemonade stand and know exactly how much output I should produce in order to maximize the profit that I'm going to collect at the end of the day. So in order for any firm to maximize its profit, it wants to produce at the level of output where marginal profit is equal to 0. All right, so using this marginal analysis, we can generate our profit maximizing rule. And this profit maximizing rule is going to hold for any firm that we look at in this class. So a firm is going to maximize its profit by producing the level of output where marginal revenue is exactly equal to marginal cost. So this is always going to be our profit maximizing rule. The reason for this is because when marginal revenue is equal to marginal cost, our marginal profit is going to be equal to 0. So what this tells us is that the firm cannot earn any additional profit by changing the quantity that it produces. If it increases its production beyond this quantity of output, its profit is going to go down. If it decreases its production beyond this level of output, then it's missing out on some additional profit. So what a firm is going to do is it's going to look for the quantity of output where producing one additional unit is going to generate exactly as much earnings as it would cost to produce that additional unit. Once the firm reaches this point and produces at this level of output, it has maximized its profit. All right, so maybe you're not convinced on this profit maximizing rule just yet, but let's look at some counterexamples to see why we need this MR equals MC condition to be true. So let's imagine that our business or our firm is producing at a level of output where marginal revenue is greater than marginal cost. If my marginal revenue is greater than my marginal cost, this means that with each additional unit of output that I'm producing, my profit is increasing. If marginal revenue is greater than marginal cost, then my marginal profit is going to be positive. So I should produce more, right? If my profit is going up as I increase my output, I want to take advantage of that and I want to produce more. On the other hand, if my marginal revenue was less than my marginal cost, this means that for each additional unit of output that I produce, I'm actually losing money. My marginal profit is going to be negative in this case. And so if I'm producing at a point where my marginal revenue is less than my marginal cost, I should cut back on my production. Each additional unit that I produce at this point is actually reducing my profit. So we're looking for this kind of Goldilocks situation. We don't want to be producing too much. We don't want to be producing too little. We want to be producing the perfect amount where our profit is maximized. Now let's take a closer look at this profit maximization rule under perfect competition and see how we can illustrate this on a graph. For any firm, they're always going to maximize their profit by producing at the level of output where marginal revenue is equal to marginal cost. But when we're looking at perfect competition, all of our firms are price takers. Because firms can't control the price of their product, they're just accepting the market price. This means that marginal revenue is always going to be equal to the price. So remember that marginal revenue is the additional revenue that's earned for selling an additional unit of output. Because price is constant at that market price, marginal revenue is also equal to that constant price. So if I was operating a lemonade stand and the market price for a cup of lemonade is $2, the marginal revenue that I'm going to earn for each cup of lemonade that I sell is going to be that $2 price per cup of lemonade. Using this information, we can update our profit maximizing condition for perfectly competitive firms. Our perfectly competitive firms are going to produce at the level of output where price is equal to marginal revenue is equal to marginal cost. Now, using our graph, let's see how we can visualize the profit earned by a firm when it's obeying this profit maximizing rule. I've already gone ahead and drawn a curve for our marginal revenue, marginal cost, and our average total cost. We're measuring quantity on the x-axis, and then we're measuring price and cost in dollars on the y-axis. So let's stick with this lemonade stand example, and let's imagine that the price per cup of lemonade in the market is $2 per cup. Since my lemonade stand is a price taker in this perfectly competitive market, my marginal revenue is always going to be equal to the price. So my marginal revenue curve is just a horizontal line at the value of the price. Keep in mind that my marginal cost curve always intersects my average total cost at its minimum. So my lemonade stand wants to maximize profits, so it's going to obey this profit maximizing rule. This means I'm going to produce at the level of output where my marginal cost is equal to my marginal revenue. Because marginal revenue is always equal to the price, I'm producing at the quantity of output where all three quantities are equal to one another. So that's given to me by this orange point here. So what I'm doing is I'm looking for the point where my marginal revenue is equal to my marginal cost, and then I want to find the quantity of output that is associated with this point. So let's say that the quantity of output that is maximizing my profit is 50 cups of lemonade. The other piece of information that we want here from the graph, and we'll see why in just a second, is what is my average total cost per cup of lemonade when I produce 50 cups of lemonade. And so that value is going to be given by this point here, where my 50 cups of lemonade is hitting my average total cost curve. And let's say that when I produce 50 cups of lemonade, my average total cost per cup is $1. Now, using all of this information, we can directly figure out how much profit I've earned from what we have here in the graph. In order to do this though, we're going to start with our original regular equation for profit, and we're going to manipulate this a little bit so that we can more easily apply it to what we see in the graph. So we're always measuring profit, or pi, as my revenue minus my costs. So because I'm selling lemonade for $2 per cup, and I'm selling 50 cups, I can think of my total revenue earned as simply the price per cup of lemonade multiplied by the quantity of cups that I sold. So generally, we can think of revenue as price times quantity sold. Now, if you think back to our chapter on costs, we know that we can measure average total cost as the total cost divided by the quantity sold. So I can take this formula and I can manipulate it, and instead of writing it like this, I could say that my total cost is equal to my average total cost times the quantity sold. And so I'm going to use this here, and I'm going to plug this into my profit equation. So I can think of my profit as price times quantity minus average total cost times quantity. Looking at the graph, if I want to find the area that represents my revenue, I'm just looking for price times quantity sold. And so that's going to be this very large rectangle here. My height of the rectangle is $2, my price, and the width of my rectangle is that quantity sold, that 50. So my total revenue earned from this lemonade stand is my $2 times the 50 cups of lemonade that were sold, so $100. But I don't just get to keep this revenue, I have to pay my costs, and my profit will be what's left over. And I can think of my total cost as my average total cost times the quantity sold. On the graph, that is going to be represented by the area in this smaller rectangle. So I'm looking for my average total cost times the quantity sold. And so this is going to be that $1 average total cost times my 50 cups of lemonade sold. And so if I do this calculation mathematically, I'll find that my profit should be $50. So I have $100 in revenue minus $50 in cost for a profit of $50. On my graph, what's happening is I'm taking this large rectangle, my revenue rectangle, and I'm subtracting from it this shorter cost rectangle. So my profit is going to be given by this area here on my graph. So this rectangle that's getting trapped between my price and my average total cost to produce for the quantity of output that's being sold. All right, now let's do a little practice using our profit maximizing rule and calculating a business's profit. The first thing we want to do before we do that is we can actually manipulate this new equation for profit that we made previously to make it a little bit cleaner or a little bit easier to read. So all I'm going to do here is we have these two terms that are in our parentheses, and I'm going to factor out this common Q that I have in both of them. So I'm going to rewrite my profit equation like this. Price minus average total cost times quantity. And anytime we're working with a graph for these profit maximization problems, we can use this version of our profit formula. All right, so let's go ahead and get started. So I've drawn here a marginal cost curve and an average cost curve for our firm. And let's imagine that the current market price for this perfectly competitive firm is right here at $5. So $5 is the current market price, and our perfectly competitive firm is a price taker. This means that the firm's marginal revenue can be drawn as a horizontal line at the current market price. Let's say that when the price is $5, now we want to use our profit maximizing rule to figure out how much output our firm should produce, and from there calculate their profits. My perfectly competitive firm is going to produce at the level of output where marginal revenue is equal to marginal cost, which is given by this point here. And so the quantity that this firm is going to produce is going to be the quantity that is associated with this intersection point. So this information would need to be given to you. And let's say that at this price of $5, if my firm wants to maximize profit, that it's producing 45 units of output. The last piece of information that we need here is we need to know the firm's average total cost for 45 units of output. And that will be given to us by the value that is associated with this point here. We're looking for the point on my average total cost curve that is related to this quantity produced of 45. And again, this information will be given. Let's say that the average total cost per unit is $4. Now I have all of the information I need to go ahead and plug into my profit formula. So my profit is going to be calculated as my price minus my average total cost. So $5 minus $4 times the quantity that my firm is producing and selling. So times 45. So my result here is this. In order for this firm, this perfectly competitive firm, to maximize its profits when the market price is $5, it's going to produce at the quantity where marginal revenue is equal to marginal cost. So the firm is going to produce 45 units in order to maximize its profit. Then we can calculate the profit that the firm actually earns when it produces at this point, and we'll see that the firm is going to earn $45 in profit from doing so. And remember, this rectangle here, this skinny rectangle, is representing my profit on the graph. All right, now let's look at a new scenario for our firm. So we started at a price of $5, and our firm was producing 45 units to maximize output at that price. Now let's imagine that the price in the market falls. So our perfectly competitive firm is a price taker. If we have some shift in supply or demand in our market that causes the price to fall, our firm has to accept this new lower price. So our market price falls from $5 to $2, and that brings our firm to a new horizontal marginal revenue curve at this new price. They still want to maximize profits by producing at the level of output where marginal revenue is equal to marginal cost, and our graph is telling us that they're going to produce 30 units of output in order to do this. Our graph is also telling us that the average total cost to produce at 30 units of output is still right around $4. So let's calculate the profit that our firm is earning in this situation. Our profit is going to be equal to our price minus our average total cost. The new price is $2. Our average total cost is $4. And our firm is producing 30 units of output. So what we're going to see here is that profit actually goes negative. So I have $2 minus $4. That's going to give me -2 times 30. I see that my firm is not earning a positive profit, but instead it's incurring a loss, or it's earning a negative profit. And so this is not a situation that our firm likes, right? Anytime our average total cost is greater than the price, this is going to be the case. Our firm is going to earn a negative profit, or it's going to be operating at a loss. All right, now let's look at one last scenario for profit maximization and calculating profit for our firm. Something special is going to happen if our price is exactly equal to average total cost at the profit maximizing quantity for our firm. And we're going to call this the break-even point. At this point, if price is equal to average total cost, our firm is just exactly breaking even. They're earning exactly 0 profit. So on our graph, that would put our price right about here. Our firm is a price taker, so the marginal revenue curve is a horizontal line at the price. And let's say that this is a price of $4.10. This firm wants to maximize its profits based on this price. So it produces at the level of output where marginal revenue is equal to marginal cost. And let's say it's producing 40 units of output. Now, at this point, my average total cost is exactly equal to my price. So this point right here is both my price and my average total cost. So when I move over here to use my profit formula, to calculate the profit that my firm earns when it's producing 40 units of output. I'm going to have my price of $4.10 minus my average total cost, which is also $4.10, times the 40 units that I'm producing. And so what I have here in my parentheses is going to be equal to 0, right? I have $4.10 minus $4.10. So that tells me that my firm is earning exactly $0 in profit. So they're just breaking even. The revenue that the firm collects from selling its product exactly offsets the cost to produce. So there is no profit rectangle here. Our firm is earning exactly nothing. Using this profit maximization rule, we figured out how a firm is going to determine the level of output that it should produce in order to maximize its profits. But what we saw is that a firm doesn't always earn a positive profit, right? Making money is not guaranteed. Sometimes when we go through this profit maximization calculation, we see that the firm isn't earning a positive profit, but instead it's minimizing its loss. So whatever level of output we get using this profit maximizing rule is the firm's best response to the current price in the market. If a firm sees, though, that it's operating at a loss, then it has another decision to make. Should I keep producing and keep incurring this loss? Or should I shut my business down? So now we want to talk about this operation or shutdown decision for a firm in the short run. Keep in mind that in the short run, a firm is going to face both fixed costs and variable costs. So on my graph over here on the left, I've drawn my marginal cost curve, which is intersecting my average total cost curve and my average variable cost curve at their respective minimum points. Because we're talking about perfect competition, we know that our firms are price takers, so marginal revenue will just be equal to the prevailing market price. As we showed before, if our price is greater than average total cost, our firm is going to earn a positive profit. So there's no concern here. As long as we're making money, we're happy, and we're going to keep producing. Truthfully, our firm is even going to continue to produce if it's breaking even. So as long as price is greater than or equal to average total cost, as long as profit is 0 or better, our firm has nothing to worry about, and it's going to continue producing or continue operating. But what we'll see is that once our price falls below average total cost, as we showed before, then our firm is earning a negative profit. Once our firm starts operating at a loss, it has to decide whether to keep going or to shut down. So this short-run decision for the firm is basically the decision to keep operating, keep producing, or kind of put the business into hibernation. In the short run, our firm isn't going to decide whether it's going to exit the industry entirely and completely go out of business. If it decides to shut down, it's just going to sleep or going dormant until conditions in the market hopefully improve. So when our firm is operating at a loss, price has to be less than average total cost. But how severe that difference is going to determine whether the firm keeps operating at a loss or if it shuts down. If our firm is operating at a loss, but it can still cover its variable costs, then it's going to continue producing. So even if price falls below average total cost, as long as price is greater than average variable cost, the firm will continue to produce even though it's operating at a loss. We can think of it this way. Imagine that I am operating a restaurant. The only fixed cost for my restaurant is the rent that I need to pay to use my restaurant space. Let's say that my variable costs are the cost to pay my employees and the cost to buy my ingredients. If I can't pay my rent, or if I'm late on my rent, as long as I can continue paying my employees and buying ingredients, then I'm going to stay in business. So as long as I can cover my variable costs, I'm going to keep going. But if the price falls too low to where now I can't pay my rent, I can't pay that fixed cost, and I can't afford to pay my employees, then I'm going to shut down my operations. The point here is that if a firm loses less by staying in business, then it's going to stay in business. If it would lose less by shutting down completely, then it's going to choose to shut down. Now let's see what this looks like on the graph. So as long as price is greater than or equal to average total cost, our firm is happy. So if our price here is equal to this average total cost at its minimum, here's our marginal revenue curve. My firm is earning zero economic profit when it's choosing to produce at this point here. So as long as price is at or above this level, our firm is going to be happy. They're going to continue producing. Once the market price in the short run falls below P1, then our firm is earning a loss. If the loss is not that severe, so if the market price falls between P1 and P2, then the firm is going to continue operating and just eat this loss. This is because if the price falls within this range, my firm can cover its variable costs, but not its fixed costs, so it loses less by continuing to produce and keeping that revenue stream open, compared to what it would lose if it shut down entirely and had to pay all of its fixed costs right away. Lastly, if the market price falls below this average variable cost, if market price falls below P2, now my firm is operating at a very severe loss. The firm can't afford to pay its fixed costs nor its variable costs at this point, and so it's going to choose to shut down temporarily to minimize its loss. So the firm will shut down and stop producing. Now keep in mind that this is our firm's operation or shutdown decision in the short run. And we know that this is the decision in the short run because our firm is facing both variable costs and fixed costs. In the long run, now all costs become variable. So in the long run, our firm only faces variable costs. And this is because in the long run, all inputs to production are variable or adjustable, unlike in the short run. So now there's no reason for us to split our average cost. Cost into variable costs and fixed costs. All costs are variable, so total cost is equal to variable cost. So when we're looking at the long run, we're going to go back to this simple graph where in terms of cost curves, we're going to have our marginal cost curve and our average total cost curve. This simplifies the firm's production decision in the long run. As long as the firm is breaking even or doing better than that, so as long as the price is greater than or equal to average total cost, the firm is going to keep producing. As long as they can earn a positive profit or break even, they're going to keep doing so. But if the price falls below average total cost, as soon as the firm starts earning a loss in the long run, they're going to exit the industry and close their doors forever. This is because in the long run, the firm can't temporarily shut down to avoid some of its costs. It either produces and incurs some costs, or it closes down forever and it no longer has to pay those costs. So in the long run, our firm faces these two decisions. This entire time that we've been talking about profit in this chapter, we've always been discussing economic profit. And so what this means is that when we're calculating profit here, we're measuring both a firm's explicit costs and its implicit costs. So as long as a firm is breaking even, this means that it's earning just as much profit as it could if it went into some other industry. So there's no other better option out there. It's doing the best that it can. What we want to talk about now is that under perfect competition, economic profit will naturally converge to zero in any market. We'll show why this is and how these conditions of perfect competition make this happen. The main idea that we're going to look at here is basically how the entry of new firms or the exit of existing firms in an industry is going to cause economic profits to converge to zero in the long run in a competitive market. When we're talking about firm entry, what we mean here is that we're seeing some pattern where new firms are entering an industry and starting to produce the products that are sold in this industry because they see that profits have gone up. So profit is like the incentive, or profit is the reward that firms are looking for. So if some entrepreneurs see that some specific industry is earning a lot of profit, they want to try to get in on that industry. So we're going to have new firms enter that industry to try and extract some of that profit. On the other hand, if some existing industry is experiencing a lot of losses and these existing businesses are starting to go into the red or into the negative, then we're going to see some exit. This is when existing firms reduce their production or shutter their doors entirely because they're seeing this pattern of sustained loss. This creates a kind of push and pull here that is going to center our market in a long-run equilibrium where each competitive firm is earning zero economic profit. All right, so now what we're going to do is we're going to combine our model of supply and demand with our model of a firm's costs and its production decisions to see how free entry and exit into the market pushes economic profits to zero in the long run for competitive firms. So the key point here is that because firms can freely enter and exit the market at will, they will do that in response to any shocks in our market that change the price and affect the profits that can be collected. So let's look at the soda market in this example. On the left here, we have a graph of our soda market, our downward sloping demand curve, upward sloping supply curve, and our equilibrium is telling us the current market price for soda. So we've labeled that P1. Now on the right here, we have a graph that is representing the costs and revenues for our single soda producer. So this is just the graph of the cost for one firm in this soda market. Because this firm is a price taker, it's just accepting this price P1 that is prevailing in the market, and this is giving us that horizontal marginal revenue curve. So from where we're starting so far, our single soda producer is just breaking even. And this will be the case for every single firm in this market. When price is equal to average total cost, we know that profit will be zero. Now let's imagine that we have some change in our market. Let's say that there is some increase in the demand for soda. So maybe consumer preferences change and they want to buy more soda. As we know, this is going to cause demand for soda to increase and shift our demand curve to the right. When we have this rightward shift in demand, this changes the equilibrium price of soda in the market. We move to this new equilibrium point here at E2, and the price of soda rises. Now our firms are price takers, so they just have to update the price that they accept in the market, and this means that the marginal revenue earned by firms for each can of soda that they produce is going to increase. Now our firms are choosing to produce at a new quantity. Before, their profit maximizing decision had them producing at this quantity, where marginal revenue was equal to marginal cost. After the price increase, they're going to produce here. But the important thing that we see is now our firms are no longer just breaking even. Now the price that they earn is above the average cost per unit that they produce. So because P2 is greater than the average total cost, now our firms are earning a positive profit. And when other business people or entrepreneurs notice that soda producers are earning this positive profit, that's going to incentivize them to enter the industry. So a bunch of new soda businesses are going to start up and start producing and selling soda. Now, if we think back again to the supply and demand chapter, if we have new firms entering the industry, this is changing the number of sellers in the industry. So what's going to happen here is that the supply of soda is also going to increase. So our supply curve is going to shift to the right. And what we'll see here is that this is actually going to push the price back down to its original equilibrium value. So we're going to end up at this new equilibrium point, E3, and we'll see that the price has fallen back down to P1. So these new firms enter the market. Now each competitive firm is facing this price P1, and they go back to that break-even point. So because firms can freely enter the market, when there is an increase in demand, this is going to push up supply, and this will restore firms to that long-run zero economic profit. Now, we can actually show this same phenomenon in reverse if we wanted to see how our market and our firms would respond to a decrease in demand. If we had some event that occurred that caused a decrease in demand in our market, that would push our demand curve to the left, and that would push the equilibrium price down. If the price falls below our break-even point for our firms, this is going to push their profits negative. Their average total cost is going to be greater than the price. When profits go negative, some firms are going to need to exit the industry. As firms exit the industry, supply is going to decrease. As supply decreases, the price is going to be pushed back up to P1, and we'll get back to that equilibrium point where each firm is earning zero economic profit. All right, thanks for watching, and I'll see you guys in the next one.